week.
Good morning, ladies and gentlemen. Thank you for waiting and welcome to the ING media call. At this time, all of the participants are in the listen-only mode. After the presentation, there will be an opportunity to ask questions. I would now like to hand the conference over to Mr. Ralph Hamers. Please go ahead, sir.
Okay, thank you, operator. Welcome all for joining us in this call this morning, where we'll discuss our highlights of the financial achievements and the strategic progress in the second quarter of 2015. With me is Wilfred Nagel, Patrick Flynn, our CFO, who normally also joins, can't join us today for this call, regretfully, but he will certainly be there next time. By the way, this media call is also streamed live on Periscope, the video streaming service of Twitter. So if you want to also see us, you can watch it. So let's start with the strong results of ING Bank. ING posted a strong set of commercial and financial results during the second quarter of 2015. ING Bank's underlying net result was 1.1 billion, up 21% year on year. ING Bank's return on IFRS EU equity rose to 11.8% for the first half of 2015, from 10.7% in the first 6 months of 2014. Our cost-income ratio was 53.2%, and that's down from 55.5% a year ago. So also an improvement in cost-income ratio. It's an improvement of 2.3 percentage points. And this result was driven by continuing strong commercial results in new loans, 9 billion of new loans extended and 9 billion of deposits received in the second quarter, as well as lower risk cost, 13% lower risk cost year on year. We made significant progress in building sustainable balance sheets in key challengers and growth markets, as we call them, like Germany and France, with funded commercial banking assets in Germany increasing ninefold over the past 5 years to reach 10 billion euro. And I'm particularly proud of the fact that we attracted over 600,000 new customers in the first half year of 2015 and became the primary bank for another 250,000 customers in the first 6 months of this year. Then on the results of ING Group in the second quarter, ING Group booked a net result of 1.359 billion, or 35 cents per share, which includes the insurance results and the deconsolidation of NN Group. Our stake in NN was reduced to 37.6%. ING Group's capital position further strengthened in the second quarter. The fully loaded Core Tier 1 ratio is now at 12.3%, and that's an increase from last quarter at 11.6%, and we continue to allocate our resources efficiently. Now, all of this allows us to pay an interim cash dividend of 24 cents per ordinary share for the first half of 2015, which reflects 922 million, or 40% of the underlying net profit. On strategy, let me say a few words here on the progress we're making in executing our Think Forward strategy. So besides the fact that clearly, loan growth is coming through, deposit growth is going through, the number of clients are coming in, that just doesn't just happen. It is really because of the effort of all of our people to improve the service to our clients and actually deliver a differentiating customer experience. And last quarter, I gave you a couple of examples of how we've done so on the consumer end of the clients segments. This quarter, I have 2 examples of what we're doing for the SME segment. So for example, in Poland, we're using advanced analytics to pre-approve loans for SMEs. We've really invested in this, and we've already helped 75,000 SME clients with these pre-approved loans. In Belgium, we have teamed up with an online invoicing service, Koala Books, as they call it, and through that invoicing service, our SME clients can actually manage their cash management, their cash flow much better, and therefore their financial situation much better. Now these initiatives, combined with the growth in the number of customers and new business, show that we're really making progress on innovation on one side and finding better ways to empower our customers to stay a step ahead in life and in business. And with that, I'm happy to take your questions.
Ladies and gentlemen, we are now starting the question and answer session. When you have a question or remark, please press star 1. The first question is from Mr. David de Jong from Bloomberg News. Please go ahead.
Hi, good morning, gentlemen. So as deposit pricing pressures continue and SCB Private runs its course, how far can you offset ongoing margin pressures by switching clients to other savings products?
It's not necessarily what we do. So basically, both on the lending side, if it comes to mortgages, or on the savings side, clearly we follow the market developments and see how we can best provide service to our clients and also give a good and competitive rate on both sides of the balance sheet. And that's basically the way we manage it. And it's really in the differentiation in the service through which we gain a lot of new clients than per se on managing through different products. So we're competitive on the rates, and we have a good service. So that's basically, we're not really managing from one product to the other product. As you know, in general, certainly on the consumer end of the spectrum, we're more and more a direct bank in which consumers decide themselves as to what they want to do, and it's really up to them how they invest their money and how they change from one account to the other account.
I guess let me rephrase the question: is how are you? What do you see as the main things to tackle the pressure on your margins, basically?
Well, I think the first thing to do with pressure on margins generally is look at the cost structure of the bank, and that goes hand in hand with the move to digital. So on one side, we're investing heavily in digital because that's basically where the trend is, and where our customers, whether business customers or private customers, that's where basically also their behavior is tending towards. So we're investing heavily on the digital side of things, but on the other side, that also gives rise to further decreases in cost in markets like the mature markets in the Netherlands and Belgium, where we are running restructuring programs. So the way to manage first a decrease in margin in itself is through cost structures. On the other side, clearly, it is also by building scale. So it's growing the volume of your business, growing your lending, growing your savings, and that's exactly what we're doing. And then if you're not successful at both, you may want to look at how do you further manage your margins. The way we have done so up to now, it's very much more on managing our asset side of the business into different asset categories where the margins are higher, which often also have a different risk profile. We're not going outside of our risk appetite. We're growing really in the things that we know very well, like structured finance, industry lending, where we're growing very fast. The consumer finance business in Germany is growing 10% per annum, and you have some better margins in those business, helping your customers there. So it's a combination of all these factors through which you manage your income and you tackle the challenge on margins, than actively managing on the rates.
Gotcha. Thank you.
The next question is from Mr. Ivo Bokkering from Financiële Dagblad. Please go ahead.
Yes, good morning. I have a question about the customer lending. This was up about 6%, but Netherlands showed a decrease again. I was wondering if you could elaborate a little bit about that decrease, and also mid and longer term, if you see that growing again, and what kind of segments ING could grow there.
Yeah, so specifically to the Netherlands, we have to differentiate. So on one side, we see what you're indicating is we're not growing because the book is not growing on our balance sheet. If it comes to mortgages, for example, we are very active in the market with extending mortgages. But clearly the repayment on mortgages, given the fact that we have a large book, plus the fact that we're still transferring mortgages from the Dutch ING book to the NN book, which is a program that will continue and that we have published before, you will see our mortgage book in total going down. So that's one effect that you see on our balance sheet. But it doesn't mean that we're not extending mortgages. On the contrary, our net production, our production in the mortgage market is good and healthy in the market shares that we normally kind of look for. So that's the mortgage side of things, and we actually see a positive development. Now, coming back to the two more business-like segments, we see a picked up demand in the business segment of the larger corporates, with some more investments and growth coming through there, more exports coming through there. So we see a pick of demand in itself. And then specifically, if we talk about the SME business, we see demand stabilizing from last quarter. So there is demand. We are honoring that demand, but the repayments under the loans that are on our books are more than the new production. We expect demand to be picking up in the third and fourth quarter if it comes to SME. But for the moment, we do see that the demand that is there and the production that we have in the SME book is lower than the repayments under the SME book.
Okay, and this is a trend that will continue in the coming quarters.
Well, as I said, we do expect that the SME demand will pick up in general in the market in the next 2 quarters. Whether then our book will grow is another question, because it really depends on how quickly other companies then also repay their loans. So it's a mix of the growth of the book is a mix of the repayment of clients and the pickup of new demand. And whether that then will be completely in balance, we will see. But the good thing is that demand has stabilized, and we expect it to be picking up, which is a good sign in itself for SMEs.
Okay, thanks.
Next question is from Mr. Edwin van der Schoot from Telegraaf. Please go ahead.
Yes, good morning. Thanks very much for the opportunity to ask these questions. I've got a question on savings, on interest on savings accounts, and as well on the mortgage side. I mean, this morning in the analyst call, I thought I heard that about 50% of the mortgages in ING's book have been refinanced. I seem to have heard that was for Europe as a whole. Can you say something about the Dutch situation? So are a lot of Dutch customers, are they refinancing their mortgage and making use of low interest rates? And where are we? Do most people finish this process in the first quarter, or is this still an ongoing process? The other question I have on the interest rates is the savings accounts. We still see a trend of interest rates dropping. In your perception, Mr. Hamers, where's the bottom end of this? And will it be possible, do we have to fear maybe even for negative interest rates on consumer savings accounts?
Okay. Well, thanks for your questions, Edwin. So on the first question, in the analyst call, that was particularly on the Belgian market, where we have seen a refinancing, a wave of refinancings over the last 3 to 4 quarters in the Belgian market, and that's what's happened. In Holland, we do see refinancing as well, not to that extent. Clearly, clients come and see whether they can benefit from lower interest rates, either to move to variable or to lower fixed going forward. And in those cases, as you know, either there is a fee arrangement, or there is a rentemiddeling, as we call it in Holland. We see some of that happening, but not to the extent that we've seen it in Belgium. So that is not necessarily happening in Holland to that extent. And then on your savings rates, if you look at where we are in Europe, we see savings rates of 50 to 60 basis points in most of the European countries. In Holland, we're at 80 basis points. At least ING is at 80 basis points at this moment in time. Interest rates are low. It really depends on how long this situation of low interest rates lasts. If that will give more pressure on that, it's really something that the market determines, and how you have to align with the market if it comes to the savings rates. I think we're far from getting into a situation where they are negative, although we do know of countries in Europe, but not in the Eurozone, which consumers also have negative interest rates. But in the Eurozone, that's not the case, and I think it will take some time before we get there.
All right. So, and then maybe just on the mortgages, can you quantify the amount of Dutch customers that's refinancing their mortgages?
I don't have those numbers at hand, honestly. We had them at hand for Belgium, given the fact that we had to adjust our underlying hedging in Belgium, and that's why we were so specific about it in the analyst call. I don't have the specific numbers in Holland, but the people on the media team here can give you more numbers later today if you're interested.
Excellent, that would be nice.
Yeah, so let's just set up a call and let's get you the numbers that we have. Yeah.
All right.
Okay.
For questions or remarks, please press *1. Chairman, there are no further questions.
Okay, thanks. Maybe there are questions through Periscope. I see one coming in, which is one of the questions: where did the 600,000 new customers come from? Well, that's an interesting question. They come from the competitor. Clearly, we see customer growth across all of our franchises, also in Netherlands. We've seen customer growth in the first 2 quarters of this year, but the real strong growth is clearly in the markets where we are a challenger, or uitdager as we would call it in Dutch. A challenger to the extent that that ING has been at the front of digital development in internet banking and mobile banking all around the globe. And you see that many of these franchises that have become real big banks now, for example in Germany, where we have more than 8 million customers, that we have real growth momentum there, where clients join us and really like our service much better than the banks in those markets. And we benefit from that. Last year, we gained 1.2 million of new customers over the total of 2014. And we see that growth continues, and that is really because the service offering through our digital channels is so much easier, and the easiness to deal with us as a bank is so much better than the local banks in Italy and France and Germany and Spain and Australia where we're active. And that's where they come from. Then I see another question coming in, which is: are your results a sign of recovery in the markets? Yes, I think so. I think certainly if it comes to the growth on the lending book, partially we see a sign of recovery. Partially it's also gaining market share for ING across the globe in, for example, a business like structured finance. We're a global player there. We're a top 5 player in structured finance, and we just see that we are taking market share in those activities. On the other side, if you look at the results and the risk costs as part of that result, we see improving risk costs. And maybe it's good to give the word to Wilfred to give us a peek there as to what he expects there and whether he sees a recovery.
Yeah. Indeed, as Ralph says, you see the economic recovery coming back in our risk cost, partially because new provisions are coming down, but more importantly at the moment, because we're seeing a lot of recoveries and therefore write-backs of provisions that we took in the earlier part of the cycle, and that's particularly the case for the real estate finance books, to mention one example of a portfolio that has had a lot of attention over the past few years because it created for a lot of banks significant provisions. And although we didn't do very badly, but we certainly had our share of provisions on the book as well, and we're seeing very significant write-backs at the moment, for example in Spain. But I think it's reasonable to expect that that will over time also start happening here in the Netherlands, where there was a significant part of that book, and we still have about 50% of our global real estate finance book here in the Netherlands. That's one example. The other example, which you don't see as clearly in the current quarter results, is that we're also seeing an improving trend in Dutch mortgages in terms of provisioning. You don't see it as much right now because of a bit of an anomaly where house prices, of course, went up a bit more sharply than they normally would have towards the end of the year prior to the abolishment of the gift tax exemption. So we saw, because this is model driven to a large extent, a relatively low provisioning in the first quarter because of the improvement in the house prices, a bit lower than it would normally have been. Now we're seeing the opposite effect where with a bit of a lag you now see the drop in prices in the first quarter after the new year when the demand because of the taxes fell away a bit. And that translates now in slightly higher provisions than we would on the normal trend line have had. It's a bit of a technical story, but what I'm saying is the underlying trend also on mortgage provisioning in the Netherlands is positive, i.e. the provisions are coming down. We see the non-performing loan percentages coming down as well. And we're also seeing the shorter arrears, so people who are not in default yet but are, let's say, 30 or 60 days overdue, also those percentages are coming down, which is an early indicator of what we can expect on the NPL side later on. So back to the core question, are we seeing a recovery? Indeed, I think you can say that the risk costs are also showing that as a trend.
Okay. Any more questions? Maybe the operator on the back of these answers.
Yes, there is one question from Mr. Frank Thewens from Read Business. Please go ahead.
Yes, good morning. I have one question about the cost-income ratio on the retail banking side. I saw a pretty rise there. I wonder what you see as a sustainable level and how you plan to bring that down, and also on the return on equity. There was also a slide there, especially in Belgium. I wonder if you can elaborate on that one.
Well, the cost-income ratio for a bank, clearly we measure that per business line and per country. But in the end, we have an ambition that we should be between 50 to 53% across the board in ING in 2017. So that's the aim. On one side, you can measure it by segment. On the other side, in the end, you manage a total bank with a total infrastructure to support the bank, and therefore we also look at the total bank, and that's why in the end, for specific businesses, it gives kind of an insight as to where you are, but it's an overall kind of indication as to how efficient you are. If you truly want to manage efficiency, you have to dive deeper, and you have to look at cost over client assets and cost over client liabilities, and that's what we do. So just the cost-income ratio, if it is not improving, that's a sign in itself, and you have to take a closer look. The ambition for ING is between 50 to 53% across all the franchises. Then the other question then on the return on equity in Belgium, I don't have the number from the top of my head specifically for retail Belgium, but I'm sure that has to do with the fact that we had to basically take a negative income on the change in hedges. So the income in Belgium on the Belgian mortgages was lower for the quarter, and that has probably caused a bit of a dip in the return on equity quarter on quarter. Overall, generally, the Belgian banking business makes a very decent return on equity, so we're not necessarily concerned about that.
Okay, and then one follow-up question then. What measures can you take to lower cost more than you have thus far?
Well, honestly, It really depends where the opportunities are and also how quickly the world is changing. If it comes to, for example, on the consumer end, the world is changing very fast. If it comes to people wanting to do more and more of their banking in a mobile way, that makes you have to invest a lot on one side. On the other side, in the end, regretfully, you will probably work with less people because the operations and the activities will be more digitalized, and therefore the operations themselves are more straight through and digitalized, and therefore you work with less people. And in the end, therefore, you could save some cost. But in the end, it's a combination of how you grow, how you invest, and how you restructure. And clearly, continuously, we look at how we can ensure that we manage things as efficiently as possible across the different activities that we have. And as I said, just 3 quarters ago or 2 quarters ago, we announced this additional restructuring in the Netherlands. We're still working on a restructuring program in Belgium that we announced in 2012. We are working on a restructuring program in the commercial bank across the globe, even, which we have kind of further enlarged. Also in the fourth quarter last year, where we saw further room for restructuring and investments on the commercial bank. So where we see, we will continue to restructure and invest in order to improve our services.
Okay, thank you.
Chairman, there are no further questions.
Okay, then I'm looking at Periscope again.
No
more questions?
No.
Okay, so then, well, thanks for joining us in this combined call and Periscope broadcast. To wrap up the call, ING had strong second quarter underlying results of 1.1 billion. It's a 21% increase year on year. It's driven by strong loan and deposit growth, around 9 billion each. In the first half year of 2015, we have gained over 600,000 new customers and became the primary bank for another 250,000 customers. And I think that all of these results basically demonstrate that the Think Forward strategy that we launched a year and a half to 2 years ago is really on track. Thanks for your attention, and hope to speak to you again at the third quarter results on November 4th. Thanks a lot.